The S&P 500 is trading at fresh record highs again despite rising oil prices, sticky inflation worries, and unresolved geopolitical tensions in the Middle East. Investors remain absolutely captivated by the AI story, with AI hardware names now attracting fresh capital flows despite growing concerns over the cost of the AI race. Meanwhile, gold has overtaken US Treasuries as the world's largest reserve asset held by central banks, highlighting a deeper unease about debt, currencies, and long-term stability. So welcome to Swissquote's Daily Market Talk. It's Wednesday, the 3rd of June. I'm İpek Özkardeşkaya, and we will talk about the latest market news and how they diverge from the reality. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
I'll be honest, it's been hard this morning to wrap up the market news and match the data with the price action, as the Middle East tensions and the rising oil prices as a result of it, and rising inflation levels do no longer bother investors. And that's a big problem, because as a rule of thumb, when it comes harder for me to explain why the market is moving the way it does, it often means that something is about to give. But when? I don't know. Looking at the major market news yesterday, the S&P 500 advanced to a fresh all-time high level again as yields remained flat. Meanwhile, oil prices kept pushing higher on stalling peace talks between the US and Iran. Miscoordination or lack of coordination between the US and Israel regarding Israel's operations in Lebanon, and that 6.75 million barrel fall in US oil inventories last week as per the latest API data that was released yesterday. The barrel of US crude is pushing above the $95 per barrel level again this morning, keeping investors alert regarding another wave of higher oil prices that could revive inflation worries and the sell-off across global bonds. But anyway, US session gains yesterday were shouldered by non-technology names for once, with weakening appetite in big technology after Google dropped 3.80% in yesterday's trading session, simply because investors didn't appreciate the $80 billion funding plans to finance extra AI spending there. Other big technology stocks traded mixed, as rotation out of software and mega cap AI spenders and into AI hardware names continued yesterday. The biggest market move yesterday in the US trading session was that 32% jump in Marvell Technologies stock price, not on earnings, not after announcing a new technology, but after Nvidia CEO Jensen Huang said that it could be the next trillion-dollar company. It took investors just one sentence from Jensen Huang to send Marvell up by 32% yesterday. Elsewhere, HPE spiked 20% after giving a sales outlook, at least that top analyst estimates, and other hardware stocks followed the move higher. So today, it is all about the AI hardware, so it could be computers, data centers, or semiconductors. These are the companies that see their stock prices rally relentlessly. Their stock prices are rising in almost vertical moves, calling for caution regarding the strength of these moves and the parabolic rise that we see here. It looks like it cannot be sustainable. So it will be interesting to see whether this AI hardware rally could keep the momentum going if the big technology falls out of favor and yields push higher again. I would say no, not if the market breadth doesn't widen again. And for the latter, lower yields would just be great. So I'm thinking maybe, but just maybe, the data could help, or maybe it will not. Let's see. On the data front, yesterday's data, for example, showed that the US job openings increased in the month of April, but the surge came alongside weaker hiring and lower quits, suggesting that employers are posting jobs more readily than they are filling them. Later today, the US will announce its latest ADP report and a set of S&P and ISM PMI numbers. A set of strong figures here may not fuel appetite if price pressures mount along with the headline figures. Look, in Europe, the latest inflation data looked all but soothing yesterday. The euro area inflation surpassed the 3% mark in the month of May for the very first time in more than 2.5 years. Core inflation rose more than expected to 2.5%. 3% level, and services inflation in the euro area jumped to 3.5% level as well, as the whole continent continued to grapple with higher energy prices due to the Middle East war. If the European yields didn't react much yesterday, it was certainly because most of the increase in prices was already priced in, but there is still no doubt whatsoever that the European Central Bank will be raising the interest rates when it meets next week. The latter could be bad news for the Stoxx 600, but the Stoxx 600 gained yesterday, pushed higher by European technology names. Shares of ST Microelectronics, for example, jumped more than 15% after the company raises data center revenue outlook, while Infineon Technologies and Schneider Electric were also among the stocks that rallied strongly yesterday in Europe. So overall, European technology sector gained up to 3.4%, but equity futures are looking quite flat this morning across both sides of the Atlantic Ocean. Let's see if the technology appetite could keep the things together again today. Elsewhere, a report from the European Central Bank showed yesterday that gold has taken US Treasuries as the world's largest reserve asset held by central banks, with a 27% share. The latter comes with little surprise, obviously, as many emerging market central banks, including the Chinese Central Bank, for example, have been replacing their US Treasury holdings by gold to reduce their exposure to the US debt, as the US debt looks increasingly unsustainable today and the US geopolitical relations with the rest of the world deteriorate. But gold's rising weight in global reserves is also boosted by its valuation, because the yellow metal is worth more than 30% today than it was last June. And if we correct for valuation effects, the share of US Treasuries continue to be notably higher, somewhere around 26% of the global reserves, while the share of gold and euro as reserve assets stand near 16%. That means that both gold and euro have room to gain more field against the US dollar and the US Treasuries when the geopolitical outlook looks this ugly. Now, price-wise, gold has been under pressure since the end of January, when it peaked to nearly $5,600 per ounce level, and hasn't been able to perform during the Middle East war, certainly due to the speculative bubble burst preventing the yellow metal from acting as a safe haven over the past 3 months of conflict. And the price of an ounce is now testing the 200-day moving average to the downside, with a possibility of a further slide below this level. But the major support to the 2024 to date rally sits at a distant $41.15 per ounce level, which is the major 38.2% Fibonacci retracement that will distinguish between the actual positive trend and a medium-term bearish consolidation. But note that the long-term rising trend in gold stands near the $3,500 today, meaning that gold remains comfortably in a positive trend when you're looking at long-term dynamics, filtering out the past year's speculative bubble. So gold is still interesting in long-term portfolios, and the cheaper the price, the more interesting it becomes to strengthen the long-term positions. In the FX markets, well, the US dollar index remains quite flat, a touch below the 100 psychological mark. The euro dollar is consolidating just below its 50-day moving average today, despite the hawkish European Central Bank to Fed divergence, as the dollar yen is testing the Japanese officials' nerves near the 160 level that could eventually trigger a direct FX intervention. We could see or hear a direct FX intervention to cool off the selling pressure on the yen in the coming hours and in the coming days. But the only thing that could reverse the negative tide for good for the Japanese yen would be a rate action from the Bank of Japan. They said the next Bank of Japan meeting will take place on June 15-16, and no rate hike is expected this month from that meeting. Investors will still be looking for clues on when the next move could come from the Bank of Japan. Persistent inflation and rising wages support further tightening, while trade uncertainty with the US and economic fragility due to rising oil prices will be keeping the Bank of Japan quite cautious and the Japanese yen probably under pressure. That means that if you're positioned for a tactical short position in the dollar yen, make sure to take your profits after potentially temporary relief if there is obviously an intervention from the Japanese officials. On the equity side, the Nikkei can't care less though. The index is up by 1.80% at the time I'm talking here this morning, surfing on strong technology appetite, lower yields compared to May peak levels in Japan, and softer Japanese yen. The million-dollar question remains the same. Will the global stock rally continue as global yields rise? The answer is it depends. It will mostly depend on the Middle East news, but also on the level of reaction or the lack thereof from global investors to the Middle East tensions, to oil prices, and to the economic data when the AI news remains so shiny and upside potential is so high. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.